Joining us now to discuss the latest headlines is Lyn Alden. She's the founder of Lyn Alden Investment Strategy and also sits on Swan Bitcoin's board of directors. Lyn, always a pleasure to have you on the show. So taking a look at this very volatile last couple of days, there's finger pointing everywhere. Some say this is a Fed failure of raising interest rates too high, too quickly. It's a banking failure that there was interest rate mismanagement, and it was a crypto failure because of all the blowups we've had in the industry, and they make for bad depositors. So what was the critical source of breakdown in your view?
I think we can kind of put it in two big camps. So one is that the Federal Reserve is making it a very challenging environment to run a bank because you had a record level of liquidity injected during 2020 and 2021, super low interest rates, and then we've seen one of the fastest pulls of liquidity out of the banking system, as well as one of the fastest rate hikes in any 1 year period. And so that's just a fundamentally extremely challenging environment to run a bank. But then on top of that, you have individual banks obviously manage that situation better than others. And so, for example, when you look at Silicon Valley Bank, the mismanagement of the duration and other factors, how they chose to attract their deposit base, for example, open them up to more risk. So I think basically most things that try to blame one or the other are going to be missing a piece of it, because I think it's really the combination of just the sheer speed of an activist Fed kind of putting liquidity in the market and pulling it out, combined with individual bank decisions.
It's interesting because policymakers are now suggesting that maybe there should be stronger capital standards. Senator Elizabeth Warren suggesting that, and I wonder, does that mean they want higher capital requirements? I don't know that would fix the situation.
Yeah, in this situation, partly capital would help. I think overall, essentially it's funny because if you look at the pre-2008 crisis banking system, they had less liquidity than they have now. Whereas now they're actually in many ways in better shape, but they're obviously facing different challenges. So, higher capital standards, higher liquidity standards, these things do add safety to a banking system, but it's still challenged by the fact that it's there's volatility at the core of it. And the more active the Federal Reserve is at changing the size of the entire monetary base rapidly, or changing the underlying interest rates rapidly, that doesn't change the fact that it's just going to be a hard environment to operate a bank.
Well, you have a new newsletter out, How the Fed Went Broke. I see one of these charts about the liabilities and assets in commercial banks are very close, which could impact the liquidity. Maybe you can go into that.
Yeah, so basically when you look at banks, they have a mix of different assets. When you have dollars in your deposits, that's not fully backed up by dollars. That's backed up by a mix of different assets with different liquidity profiles. And what we've seen in recent months with the Federal Reserve pulling liquidity out of the market, basically letting bonds mature off their balance sheet, destroying bank reserves, that's actually helping to suck cash out of the banking system, which makes them more prone to these types of runs. Now, there is a difference between liquidity and solvency. If a bank has more assets than it has liabilities, it could face a liquidity problem if deposits pull out, but it's still fundamentally solvent. Whereas the biggest risk comes when you have both a liquidity problem and a bank did not manage its duration well, or made bad credit decisions, which is not the case here, but it's really a duration issue. In that case, you can have both an illiquid and insolvent bank. And the interesting thing is that central banks have essentially the same problem on their balance sheet. The Federal Reserve, for example, has very large unrealized losses on its security book. But of course, the key difference is that nobody can do a run on a central bank.
Right. So you said that the Federal Reserve is actually running operating losses to the tune of about $2 billion per week. So that will put their independence into question. Tell me a bit about that.
So the Federal Reserve, like many banks, has assets and liabilities, and most of the time, historically, their assets pay a higher yield than their liabilities, and they're required by law to send their excess profits to the Treasury, which historically was up to like $100 billion a year. What happened since September of last year is that the Federal Reserve raised interest rates so quickly that their liabilities are now higher yielding than their assets. Their assets mainly consist of longer duration Treasuries and mortgage-backed securities, much like a lot of these bank banks that are having some trouble. And the Federal Reserve's liabilities are, bank reserves that they pay to banks, as well as reverse repos, which are, obviously these are short duration, high yielding things. And so now the Federal Reserve is operating at a loss. It has both, just ongoing financial losses, as well as a big unrealized loss on its loan book. The main difference is that a central bank doesn't go out of business if it's technically insolvent. It just keeps operating. It's not liable to have bank runs. But what it does mean is that, one, they're no longer sending remittances to the U.S. Treasury, and so the federal government has lost a tax source, a revenue source. And two, the central bank's independence can be challenged. And I think overall we saw in Congress the other day that politicians are paying more close attention to the Fed because some of these extreme moves we've seen in interest rates, liquidity, and I think this underlying solvency issue could come up as well.
How do you think their politics will be influenced? Could they become more anti-crypto in the process?
Well, I think it's possible. I think when you have a crisis like this, you generally want to look for a scapegoat, and so I do think that the broad crypto space is one of the ways that they might go after this place, because nobody wants to take the blame on themselves. But I also think you'll just see politicization of Fed decisions, right? So, for example, any time where the central bank is trying to tighten monetary policy, you're prone to have some political pushback. Now, historically in the United States, that wasn't really the case. For example, Jimmy Carter, Ronald Reagan, a bunch of presidents going up, for many decades, did not really politicize Fed decisions. Starting under President Trump, he was critical of Powell openly, and currently at the time, it's mostly congressional Democrats that are critical of Powell. Basically, essentially, if you're trying to tighten interest rates and you're trying to ironically increase the unemployment level, obviously the political party in power risks having concerns with that. Now, like I said, historically they did not really tend to politicize it, but because the Federal Reserve's become such a large force in recent years, and because there's so much debt in the system and inflationary pressures, it's kind of inevitable that their actions get somewhat politicized, almost like a fourth branch of government.
And they're doing an internal investigation at the Fed, and there are some lawmakers calling on Jay Powell to not be part of that, so that there is some sort of independence. So certainly some politics brewing there. With the collapse of Silvergate, Silicon Valley Bank, Signature, where will crypto companies go now? And what will happen to small to medium-sized banks?
So for the first question, I mean, from what I'm seeing, you're seeing diversification in the space. Different companies are sorting out different banking relationships. I think that'll partially depend on the underlying quality of their business. If they're actually trying to solve utility purposes, I think they have a better chance of getting a good banking relationship. If their business is inherently more speculative or with less regulatory clarity, they might have trouble getting that type of banking relationship. So I generally think you'll see more of a spreading out of that space. As far as small and medium-sized banks are concerned, I think they're in rough shape, especially if the Fed tries to remain somewhat tight. Overall, most banks are solvent. The large banks seem to be pretty well positioned here in the United States, but really that long tail of small and medium-sized banks is somewhat challenged, because if they don't want a lot of their deposits and liquidity to flow out towards larger banks and towards money markets, they're going to have to increase their depositor rates, but that negatively impacts their profitability.
I found it really interesting that it's no exaggeration. You say that the Fed is basically operating a Ponzi scheme with these huge deficits. And you also say that inflation is the story right now and the coming years. What can the little guy do with their savings, with their sum of money to survive this catastrophe in the waiting, if you will?
I mean, I think this is such an extreme environment, so some degree of diversification makes sense. I mean, as far as your banking relationships go, you want to, be under the FDIC insured limit. You want to be at a bank that has a kind of a diversified deposit spread. You can consider money markets and T-bills for your, defensive liquid capital. Aside from that, obviously, I think that Bitcoin is a good long-term position to consider. Basically, as a 3 to 5 year or longer outlook, as long as you can withstand the volatility and therefore manage your position carefully. And then it's, a variety of other income producing assets, fairly hard assets, commodity, energies. I think there's a lot of spaces that people can go into, but basically they do have to re-examine how they interface and how they look at the existing banking system, because it does face more risks in this era than maybe they're used to over the past few decades.
All right, Lynn, we got to end it there, but thank you so much for joining us. Folks, read her latest newsletter, How the Fed Went Broke. That was Lyn Alden, founder of Lyn Alden Investment Strategy.